Hi everyone. You do not want to miss this episode. I've been waiting for this guest for months, and we finally got him on the podcast. I'm going to talk to Jake Fuss. He's a director of Fiscal Studies at the Fraser Institute. We're going to dig into taxes in Canada. What are they really? Who are you paying your fair share? We're going to talk about deficit. We're going to talk about productivity. We're going to talk about economic growth right from the Fraser Institute. Hi, everyone. Welcome to Control and Compound. I am Darren Mitchell, and I'm super excited. Let's dig into it. Jake Fuss from the Fraser Institute. Welcome to Control and Compound podcast. How you doing today?
I'm doing great, thanks. Thanks for having me on the show.
No worries. So you're based in Calgary, but the Fraser Institute, they do research and talk about policies and all kinds of stuff. If you haven't checked out the website, check it out. Amazing articles, great research on there. So let's dig into it, Jake. I want to talk about taxes in Canada. One of my least favorite things to pay, but one of my most favorite things to talk about. Our current government Trudeau's talks a lot about fairness and people paying their fair share. So let's bust that myth right up front. Do wealthy Canadians pay their fair share in Canada?
Well, I think one of the really frustrating parts of the aspect when we're talking about, policymakers talking about tax fairness or other concepts like that, they rarely actually define what they mean by tax fairness. So that's why I think it's really important to provide data and facts and evidence into that discussion, so we can at least have a foundation to build upon when we're having this discussion about tax fairness. So one of the things we do every year is we look at how much the top 20% of income earning families in Canada pay in taxes, both on personal income taxes and then total taxes, so including other things like sales taxes and property taxes into that equation as well. And what we find is that the top 20%, so these high income earning families in Canada, actually pay the majority of all taxes in Canada, and they pay nearly 2/3 of all personal income taxes in Canada. So they're paying a disproportionate share of all taxes in Canada. So I think that's a really good place to kind of ground the debate in then when we're talking about tax fairness, because rarely do politicians or policymakers actually then say, I think, them paying 60% is fair or them paying 50% is fair. It's really just about saying, we need to tax them more and more and more, ultimately to fund, in a lot of cases, actually excessive program spending at the federal level.
So the top 20% of income tax earners pay 2/3 of the overall taxes in Canada.
So they pay the majority of total taxes, but nearly 2/3 of personal income taxes. So there's a little bit of different category. And the reason why there's a slight difference is because personal income taxes are more progressive by nature. So you pay higher taxes as your income rises, whereas total taxes are not necessarily as progressive. So things like sales taxes or property taxes aren't necessarily as progressive as personal income taxes in that case.
Yeah, and I did a podcast recently on our average income tax rates per province versus the U.S. states. But I find, there's a lot more to when you look at the average tax bill of what Canadians pay. It's not just the income tax, which is very high, but it's a lot of other taxes that maybe in countries like the states you're not going to see. So if we looked at just the average Canadian, I'm not talking about the top 20%, but what's the average Canadian's tax bill in Canada?
Yeah, so if we look at the average Canadian family, so generally, a couple with two kids, for instance, they're paying about 45% of their annual income in just taxes. So that's not just personal income taxes, that's also things like sales taxes, excise taxes, like liquor taxes and other things, property taxes, also things like import duties that we might not think of as taxes. So some of these less or more hidden or less visible taxes that we pay too. But about 45% of their income, so almost half your income, is going just towards taxes at the federal, provincial, and municipal levels every year.
So if you don't believe tax is your number one wealth destroyer, you need to listen to this. Okay, so let's. I don't want to get upset, but you just told me 45%, the average family. We're not talking the super wealthy, the average family. And do you know off the top of your head, like what do they spend on shelter and housing and like some of those other things? Obviously less, but like it's that disproportionately large amount of the overall income.
Yeah, so taxes are easily the single largest expense for Canadian households currently. Now, they do still spend a considerable amount of money on the basic necessities, so things like housing, food, and clothing. So, about 36% of their income is going towards those items. But what we are seeing, and this has been a trend for quite some time now, is that taxes are that single biggest expense. So, these Canadian families are spending more on taxes than they actually are on all of the basic necessities combined. So it's really squeezing, pocketbooks of Canadian families over time, when a considerable amount of your income is not only going towards taxes, but the basic necessities. There's really not that much left over then, for other expenses that the household might have then.
Okay, so now I want to stick on taxes. I want to kind of dig into this relatively new, the new capital gains inclusion for personal as well as business. And then I think one of the things that's was kind of missed by a lot of the press or a lot of the people is it wasn't just the capital gains that tax change, which is horrendous in itself. But there was also a change in capital expenditures, what corporations could write off. So could you talk about those two things and just what kind of impact we think that'll have on the country?
Yeah, well, I think it's really the combination of a couple of things there. They've sort of let that sunset in terms of the provisions that allow accelerated capital write-offs for businesses, which makes it more conducive to investment over time. But then once you allow that to sunset or expire over time, then that makes you less conducive to investment in Canada. But I think even the even more damaging policy is what you've alluded to, which is the capital gains inclusion rate increasing from 50% to about two-thirds there. That's really damaging in terms of allowing Canada to be an attractive place for investment. When you're providing a disincentive for people to invest in Canada, that means that we can't actually invest in the machinery, the equipment, the citizens that we need in this country, for better job creation, for more innovation, for more entrepreneurship, and all of the things that we need desperately more in Canada right now, especially when we have such poor economic performance currently. I think that's really going to exacerbate our competitiveness challenges, especially when we're competing with other countries like United States or European nations, Asian nations, that actually have much more attractive tax systems than we do. So we're just providing a further disincentive to invest in Canada, which is something that we need a lot more of, not less of.
So how does this play out long term if you make it less beneficial to invest in Canada from a long term perspective about where we get a global economy? How big of an impact do you think that's going to be long term when we have less and less money investing in Canada? And I'll just tell you a quick story. I was at a real estate conference recently in Toronto, and I remember being there 3 or 4 years ago, and there was nobody talking about investing in the United States. And this year, of the 60 booths that were there were probably 12 or 15 that were focused on how Canadians can take their Canadian dollars, take them out of Canada, and invest them in the United States, not just for the capital gains, but for a lot of reasons, just regulatory reasons, and basically making it more attractive. And this capital gains inclusion is going to make it less attractive for people from other countries to want to invest here. How do you see that playing out?
Well, I think it really has a couple of effects, in terms of, especially for high skilled workers, so doctors, entrepreneurs, engineers. They're going to be much more likely to locate themselves elsewhere rather than locating themselves in Canada. So they go to the United States, they go to another country where they think that their dollar can go much further than it can in Canada. And similar for businesses too, not only in terms of investment decisions of whether or not to invest in Canada, they'll likely take their money elsewhere. But they may also locate corporate headquarters in another country, for instance, and we don't get those jobs that we might have otherwise, with capital gains taxes and a overall poor regulatory environment too, where it's very hard to do business in Canada compared to other countries too. So you're just providing all these different disincentives between the capital gains inclusion rate. We're not particularly competitive on personal income taxes or corporate income taxes as well. We also have a very burdensome regulatory environment. So you're just providing more and more reasons why you should not invest in Canada and invest somewhere else, which is, I think, really the dangerous and concerning aspect right now in Canada, is that we're not showing that we're actually open to business and allowing that investment into the country that we need more of to ultimately raise living standards and incomes for people over time. We're moving in the opposite direction currently.
Wow. Okay, so if we leave taxes for a second, we're making it less attractive for people to start businesses, invest in businesses, less attractive for foreign capital to come into Canada. So I want to switch gears to sort of our debt now. debt deficit, all both of those. But I heard our prime minister recently say how what a great job Canada was doing with our debt compared to other G7 countries. And it's like a lot of things politicians say. Sometimes there's more to the story. So can you just sort of address what was said and what the reality is?
Sure. Yeah. So the prime minister is using there is a very narrow measure of debt. So it's something that we call net debt. So what you do is basically take your total liabilities as a country and you subtract out your financial assets. Now the problem with the claim from the prime minister is that yes, we do look better than other G7 countries when we're just using that narrow definition of net debt. However, our financial assets actually include the Canada Pension Plan and the Quebec Pension Plan, which are worth about $717 billion as of the end of last year. So those are, obligations that are owed to current and future retirees. That's not something that we can actually use to pay down our debt. So a much more fair comparison is actually to use something that we call gross debt. So it's looking at your liabilities as a country. It allows for a lot more apples to apples comparisons to other countries. And so what we do then is we compare Canada to other advanced economies around the world, and Canada actually falls quite significantly in terms of the rankings when we're looking at the two different debt measures. So when we're looking at net debt, we would have the fifth lowest debt out of 32 countries when we're looking at net debt. But when we look at the more accurate measure of gross debt, we'd actually place 25th out of those 32 countries. So that's why I think it's really misleading to say that Canada is a very low debt country, because that actually includes the assets of the Canada Pension Plan and Quebec Pension Plan. When you use a more accurate assessment of our debt, we're actually among the most highly indebted countries in the modern world and among advanced economies when we're looking at more accurate measurements of debt overall.
And I find, every now and again, there's actually I haven't heard it in a couple of years, but every few years, people get worried about the debt and talk about the debt, but we really haven't seen anyone really get too fired up about Canada's debt. So why should Canadians care about the size of Canada's debt?
Well, I think there's really a few reasons. There's an immediate cost right away, which is governments operate just like households in terms of when you take out a loan or you have a mortgage, you have to pay interest costs. And the more debt that you take on and the higher the interest rate is, the more that you're having to pay in interest costs. So right now, about 1 in every 10 or 1 in every $9 that the federal government is taking in revenue is going directly towards interest payments. It's not going towards healthcare, education, social services, or tax relief either. And over time, if you allow that to build up more and more, your costs eat more and more of your revenue. The second thing, too, which I think is even more important, is the burden that we're placing on future generations of Canadians. Today's deficits are tomorrow's taxes. So as long as we're kicking the can down the road, consistently spending more than we're taking in, future generations of Canadians are ultimately going to face higher taxes or less services and benefits than what we're currently facing in order to actually pay for all of the spending that we're doing today. And they may not even be benefiting from all the spending that's being done today on things like old age security or guaranteed income supplements or Canada Pension Plan. Some of those things don't actually necessarily benefit future generations in the immediacy. So they may actually be paying higher taxes in the future for benefits that they don't even get to enjoy. So I think that's really the concern. And then the third issue, too, is once your debt exceeds a certain threshold, your economic growth actually begins to slow. So what ends up happening is that people's incomes aren't rising as fast as they might otherwise be. And it really provides this hindrance to economic growth over the long run, which is really concerning for living standards for Canadians. So I think it's really those three issues that I've kind of raised that are the main issues with government debt accumulation when it becomes excessive.
So I just on that topic of economic growth, I heard Canada's finance minister, say the other day about the economic growth of Canada. Leading the G7 or one of these statements they said because I been tracking the last couple of years. Where were we in a recession? Were we not in a recession? But again, that's another one of those misleading things when they talk about Canada's economic growth. So tell me what they say, and then tell me what the real numbers look like.
Yeah, exactly. So that's one of the things here too, is that it's kind of misleading to say that Canada is leading the G7 or other countries in economic growth because it's, again, a very narrow measure of economic growth when we're only looking at the aggregate numbers. So yes, we are having pretty good economic growth in terms of the GDP numbers, just in aggregate. But our population is actually growing faster than our economic output currently. And when that happens, that means that your GDP per person is actually declining over time, as it has been for really the larger part of the last 2 or 3 years here. And our GDP per person now, which is really the broadest measure of individual living standards in Canada, is actually lower today than it was 10 years ago. Which I think is really the concerning aspect too, is that not only have we not made any progress in the last 10 years, we've actually declined over time. So Canadian living standards are actually worse today than they were roughly a decade ago. So it's not just, looking at the aggregate GDP numbers saying, oh, we've increased by 1 or 2% this year. If your population is increasing by 3%, for instance, then that means your GDP per person is actually declining, because then the only growth that you're getting is essentially from adding more people to the economy to buy goods and services. You're not actually increasing productivity. You're not actually increasing, innovation, entrepreneurship, or anything that actually provides the higher incomes, the better jobs, the better living standards for Canadians. And that's really the concerning aspect for me right now, is that we're in this kind of middle of decline in individual living standards right now in Canada.
Yeah, and another factor I always track and I don't hear people talking about is along the same lines is just our productivity gap versus the states, and you referenced some of the stuff that lead to that. But can you just walk me through sort of where our productivity gap has been going the last 10 or 20 years, and what do you think the reasons for it are?
Yeah, ultimately, we have a huge problem right now with our productivity problem in Canada. The senior deputy governor at the Bank of Canada, Caroline Rogers, recently said, it's an emergency right now on productivity. Ultimately, our output per hour worked in Canada has really been slowing in terms of the growth, and in some cases, actually been declining in several quarters over the last few years here. And productivity is ultimately quite closely tied to gains in wages and income. So when you don't have a more productive economy, people don't actually get real gains in their income and their wages over time. You also don't get the job creation, the innovation, the entrepreneurship that you need in the economy. And we're moving in the opposite direction of other countries like the United States, or some of the European countries like Ireland or Estonia, that are actually doing quite well with their productivity and increasing it quite rapidly over the last number of years. And as you fall further and further behind, it becomes harder to catch up to. And I think a few key reasons why this is happening. We have a very burdensome regulatory environment that makes it very hard for us to do business in Canada and start new businesses and be entrepreneurs. We also have a very high tax environment that we've already kind of touched on, with capital gains, corporate income taxes, personal income taxes as well. And then there's other things too, barriers in the economy, in terms of it's very hard to do internal trade between the provinces in Canada, excuse me. And I think there's a lot of different factors at play here. And ultimately, Canada is not a very productive place currently.
Okay, so if we could wave a magic wand and we could appoint you head of Canada and can make all the decisions, what tax reform or policy reform do you think that could kind of take us off the path we're on and really revitalize Canada, increase our productivity, increase our real wages, lower our deficit? What do you think the policy or tax changes Canada should implement?
I think there's a number of different things that we can do. So on the business tax side of things, for instance, looking at tax reductions there to actually improve and incentivize business investment would be really important. I think we could also copy the model of a small country in Europe called Estonia. So what they do is, if you reinvest your profits back into the business, they're not taxed. But if you're dispersing those profits in terms of share buybacks or bonuses or other things, then they are taxed. So it's a different way that they do this, and they incentivize essentially reinvestment into the actual company itself, so that you get more machinery, equipment, innovation, entrepreneurship over time as well. So I think that's some of the moves that they can make on the business tax side of things. On the personal income tax side of things, I think we could look to the model that the British Columbia government took under Gordon Campbell in the early 2000s. So they actually made 25% across the board tax rate reductions at every income level. So that's one of the ways that you can incentivize economic activity. You actually improve the incentives to work, save, and invest in Canada at the same time. And I think also looking at a complete reform of our systems, so reevaluating our tax credit systems. So we're actually simplifying the tax code, making it much easier to actually navigate through the Canadian tax system, I think would be really important. And then also looking at our capital gains tax structure right now, I think becoming a lot more competitive with other countries by lowering the inclusion rate would be really important as well to actually incentivize investment in Canada. So I think those are kind of the areas that I'd start at. But I think it really involves a comprehensive review of the entire Canadian tax system, which is much overdue. We haven't really made major changes to the Canadian tax system for several decades now. And I think it's time that we had that discussion again.
Yeah, I know. Well, I know some provinces we still don't even have inflation increases in our tax brackets. As a small business owner, the $500,000 limit, I can't remember the last time that's been looked at. It seems everything keeps going up and not going down. All right, any final words before I get into where people can track you down?
No, I think that was a good discussion so far.
Wow. Well, I absolutely love it. We're running short of time, but I'd love to have you back on and dig into more depth in some of these things. I wanted to cover a lot today. But if people want to learn more about the Fraser Institute, they can go to the FraserInstitute.org and you can look up Jake Fuss, Fuss, on LinkedIn. Jake, thanks so much for your time today. Appreciate it.
Thanks very much for having me on the show.
Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.